Good morning and a warm welcome to the Latrobe Financial Investor Call for July. I'm Lillian Chin, Director of Client Partnerships at Latrobe Financial. Thank you for joining us today. During today's presentation, your lines will be in listen-only mode. We've had a number of questions sent to us ahead of time, and we will try to address these questions throughout the presentation in the relevant places. We will also take questions at the end of the presentation if time permits. To submit questions at any time during the presentation, please click on the Q&A button at the bottom of your screen. Please note that we won't be able to speak to individual account questions in this forum, but our investor team is always available to take your calls and questions on 1-800-818-818. If you have viewed our webinars or read our monthly updates, you will be familiar with our long-held view that the road to economic recovery from COVID-19 will be bumpy. To date, the Australian economy has demonstrated remarkable resilience, stilled by low unemployment, a surging real estate market, and a raft of economic indicators coming in above expectations. Yet, the spectre of pandemic risk has loomed as an ever-present threat. With major Australian capital cities and regional areas presently in lockdown or with restricted borders, it is clear that elevated pandemic risks will remain with us for some time. An important takeaway from the 2021 financial year was the demonstration of the strength and resilience of Australian property credit as a foundation asset class for income investors. Supported by systemic stability and strong underlying fundamentals, property credit stood tall in a year marked by continued record low interest rates and ever-present volatility. As we will demonstrate through this update, the Australian macro outlook remains robust. Of course, it is important that with all the noise and volatility in the market, that investors are reminded of the underlying fundamentals that will make a difference to their investments. After all, asset prices are high, interest rates are low. That makes it incredibly difficult to generate consistent, low volatility income. At Latrobe Financial, we're acutely aware of the dilemma facing investors and are leaning in to do our bit to help. So we'll explore all of those themes in today's presentation. Today, you'll be hearing from key wealth management executives to assist in relaying our thinking and insights. Troy Stratton, our Deputy Chief Investment Officer, has 20 years experience, both in London and here in Australia, across banking and wealth management. Troy has worked in senior roles with Barclays Wealth, Barclays Private Bank, and HSBC Retail and Wealth Divisions. Michael Watson, as Head of Distribution Asia Pacific, has been with Latrobe Financial now for a decade and worked within various market-facing and project roles. Michael worked across bank and non-bank financial institutions within credit analysis, portfolio management, and operations. And finally, to me, as Director of Client Partnerships, I have over 21 years experience in the domestic and international private banking industry. I have been a regional executive in Westpac Private Wealth and have worked for Merrill Lynch, HSBC, and Citibank in Singapore. To start with, let's take a quick look at the Latrobe Financial Group and how we've positioned the business as at the end of the 2021 financial year. There are 4 key points about our business that every customer and partner should know. Firstly, Latrobe Financial has long been recognized as Australia's leading asset class specialist since we commenced operation in 1952. We have circa 12.5 billion in assets under management and 450 staff. Secondly, our business has 2 key growth engines. Our asset management business is spearheaded by our 6.1 billion credit fund, which has 55,000 investors and operates in the $3.3 trillion managed funds sector. Our real estate credit finance business draws on our deep expertise in credit to deliver one of the broadest mortgage product suites available in the 2.5 trillion residential and commercial mortgage market. Both markets have enormous depth and diversity and offer tremendous opportunities for us to grow and strengthen our offerings. Thirdly, both of these engines have been tested across many decades of operations. We have managed funds and built loan portfolios for many of the world's largest and most sophisticated banks, financial institutions, and fund managers. And we've learned to build these portfolios as we build our business with the asset quality, the diversification, and the portfolio construction disciplines to weather the ups and downs of the economic cycle. Our 55,000 investors in the credit fund benefit from this same investment philosophy, the same disciplines, and the same expertise. Finally, we are a portfolio company of the New York-based Blackstone Group. Blackstone has over US $684 billion in assets under management and own 80% of the business, with the remainder owned by senior management. Blackstone's global network of businesses gives us real-time insights into market trends that complements the insights we derive from the circa 12 billion in assets we originate annually. A key point of difference for our business is the diversity of our funding base. We have an unparalleled funding book spanning the world's largest banks and financial institutions, with whom we have 3.7 billion in mandates, debt capital markets. We've issued almost 8 billion in RMBS bonds, and of course, our 6.1 billion credit fund. This profile is unique in the market and allows us to capitalize on growth and portfolio opportunities beyond that our peers can pursue. And that's to the benefit of all of our investors. Importantly, we pursue all growth opportunities with an unwavering commitment to asset quality. The quality of our assets is what we are known for, and we are utterly focused on maintaining the very highest standards of investment and portfolio construction discipline. On screen, you can see that asset quality has improved materially as our business has grown. In June 2016, prime and super prime assets, the highest quality loans we invest in, were 28.2% of the portfolio. At the end of June this year, that had grown to more than 38%. Conversely, the higher yielding but riskier specialist assets were 19.1% in 2016. They are now below 9%. That's a 50% reduction. Another key comparison I'd like to draw your attention to is the credit quality of the trope financial borrowers compared to our peers and the Big Four banks. While we have always taken rigorous hands-on credit analysis of our borrowers, we also undertake a credit check from third-party credit analysis provider Equifax. Equifax is an independent provider of credit searches and reporting in Australia, and among other things, provide a credit score for all borrower applicants. As can be seen by the graph on the screen, our borrower credit scores have aligned more with banks than our non-bank peers. Notably, in January 2021, our average credit score even surpassed that of the Big Four bank average, as has since maintained at or above bank credit scores. This is powerful evidence of the continual discipline and focus we place on borrower credit quality, and an easy gauge for investors to the quality of the assets that underpin our 6.1 billion credit fund. Driving this operation is the deepest, most experienced, and most expert leadership team in the business. Our CEO and SVPs have collectively over a century in the business, each with more than 17 years on average, and generally with extensive industry experience in finance, banking, and the law, prior to joining La Trobe Financial. We've built an incredible bench of industry and subject matter experts across all the disciplines relevant to delivering the highest standards of performance for our investors, borrowers, and business partners. Their skills span credit, portfolio and liquidity management, risk and corporate governance, finance, treasury, collections, and so on. We will continue to grow and develop our team to onboard high caliber industry professionals who can help us continue to deliver market-leading quality standards across our entire business. And that is our business update for the month. There has been for many years a very welcome focus on corporations contributing to society more broadly. While we've always been very mission-focused at La Trobe Financial, these broader considerations, now generally summarized as ESG, have always been fundamental to our approach to business. Indeed, the notion of serving the underserved borrower, a social loan in today's language, is why we were founded back in 1952. We know that the social license under which we operate depends on us continually renewing through our actions the reservoir of trust that we have built with our customers and business partners. Today, we have a wholly integrated approach to ESG. In 2020, in fact, we appointed one of our longest serving and most experienced executives, Katerina Neshi, our former head of marketing, as our director of ESG. Kat brings an incredibly deep knowledge of our business to her role, which has enabled her to capture and integrate the drivers of our ESG strategy. As you can see from the table on screen, our impact on our community goes well beyond the merely financial. Our governance framework has always been industrial strength and of the highest standards. That is a natural consequence, perhaps, of the breadth and sophistication of the investors for whom we have been managing money for 7 decades. We have an incredibly experienced and qualified board and a very strong culture of compliance organization-wide. Our transparency is best in market, as you can see from the portfolio data we provide to the market each and every month. At a social level, we are fiercely committed to remaining the values-based organization founded by Ray O'Neill in 1952. We have donated over $16.2 million to various community charities and causes. In the last year or so alone, we have donated $1 million to assist victims of the bushfires, another $1 million to the Epworth Hospital for coronavirus preparations, and made available up to $1 million for customers affected by the recent floods. At an environmental level, our executive committee has recently made a commitment to taking the business to carbon neutrality by 2030. On top of that, we are actively building towards a green RMBS bond and potentially a green offering within the credit fund as well. We've been taking a lot of inquiries on these issues, so please rest assured we will continue to work on these initiatives in the months ahead. I will now hand over to Troy for an update on our portfolios and performance.
Thank you, Lillian, and good morning all. Let's now turn to our credit fund and review our portfolio settings and performance at the end of June quarter. Let's start with a review of our products. Our June portfolio snapshot and metrics report is on our website and freely available to all investors and advisors, and indeed the world at large. It gives an incredibly detailed and transparent insight as to how our portfolio managers have positioned our portfolios. Let me start with an overview of our investment offerings. Investors in the $6.1 billion credit fund will be familiar with our track record of delivering low volatility income across all market cycles with a range of products to suit the risk, return, and duration appetite of investors. All our distribution rates are variable rates which are reviewed monthly and have strong track records of performance since the inception date of each. One key difference investors will notice here is the launch of the 2 new portfolio accounts. To assist in offering quality, inflation-responsive alternatives for investors, La Trobe Financial has this week launched our 6-month notice account and our 2-year account. Both accounts invest into the same high-quality asset base familiar to our other accounts, while adding flexibility and choice for investment timeframes and preferred return profiles. The new products are available now, and you can review these in full in our updated PDS, which is on our website. Investing into our new products is easy through our online platform, La Trobe Direct, or by completing an application form at the end of the updated PDS. Now, across all of our investment accounts, you can see our distribution rates, which have remained incredibly consistent throughout the coronavirus event. That consistency is, of course, a consequence of the resilience of the underlying assets in which the portfolio, which I'll cover off in a moment. Not only does this slide highlight the AUM, the low average LVR, and the number of investors within each investment account, you can also see key technical metrics that investment analysts use to assess the performance of our fund. For example, alpha measure, well, in non-technical terms, alpha measures the ability to beat the market. The Sharpe ratio and information ratios are 2 different methodologies to evaluate the risk-adjusted rate of return of investment portfolios using the risk-free and benchmark rates as baseline comparators, respectively. All of these outcomes are incredibly strong, consistent over time, and also points to the enduring outperformance of our offering. As discussed in last month's update, our asset class of property credit can be used in a diversified portfolio holding. With interest rates at historic lows and inflation becoming a talking point for future considerations, a targeted exposure to our investment accounts could add real power to your investment portfolio's income profile. As a brief update, let's talk about the classic notice account for a moment. It aims to provide investors with a reasonably stable and predictable income based on monthly variable rates of return. We welcome investors using the classic notice account in concert with other diversified holdings across the credit fund. Our 90-day notice account provides a market-leading yield with access to your funds per the fund constitution, generally available on 90 days written notification from our investors. We have, however, 12 months under the fund constitution to honour a redemption, of course. Our 12-month term account, now at an over 4.5 billion in assets under management, and is the winner of the 12th consecutive Money Magazine award in the category of Best Credit Fund for Mortgages, has continued its unblemished record of monthly income, low volatility, and with all maturity redemptions being made on time and in full. The 12-month term account remains the flagship offering of the credit fund, with wide support locally and increasingly from abroad. Now to our 4-year account, or formerly known as the High Yield Credit Account, or HYCA for acronym, offers a range of investment opportunities over a longer investment timeframe. This account invests into mezzanine RMBS and warehouse notes, all of which are originated by La Trobe Financial. Due to the longer time and difference in the underlying asset base, the 4-year account seeks a minimum investment of $250,000, whereas the others I've spoken about need only $10. And now to our Select Investment account, which provides individual peer-to-peer investment opportunities via our investment shopping list with a $1,000 minimum investment. Our peer-to-peer offerings is the largest peer-to-peer offering in the Australian market. Investors select individual investment opportunities with a risk, the return, the duration profile to suit their own individual investment objectives from our investment shopping list. This investment shopping list is providing an increasing number of investment opportunities every week, and we recommend visiting our website each Wednesday afternoon from 2:30 p.m. Australian Eastern Standard Time to view our updated peer-to-peer investment listings. Of course, if you have any queries about any of our products, please do not hesitate to reach out to our friendly private wealth team on 1800 818 818. Now, on to a little bit more of the fund's performance. The fund's performance over time has been rewarded with the strong net inflows. Anecdotally, we continue to hear from investors that consistent, low volatility income is in short supply. I'm sure that's not a surprise to anyone on this call. And our credit fund has a notable track record of meeting that exact need. You can see at the aggregate AUM viewpoint and the quarterly movement in the graph that the credit fund has resumed its pre-pandemic growth trajectory and is up almost 27% year on year. That is well ahead of our expectations 12 months ago. Interestingly, the credits fund composition at the account level has also changed. The fund's average investment tenure is up by 3.3% between 1st of January 2020 and 30th of June 2021, as investments have tilted towards more longer term. Our 12-month and longer term tenure accounts have been rewarded. That's a material improvement to our already strong liquidity profile and has been a very welcome development. And finally, it would be remiss of me not to note that the assets under management of our entire credit fund recently passed 6 billion. The entire credit fund has been a terrific performer for investors seeking low volatility income strategies, and it's really pleasing to see the level of support continuing from our investors. Now, geographically, our focus continues to be on the key population hubs around Australia. Major city and eastern seaboard exposures are central here. Our portfolios are overwhelmingly in metropolitan locations in the major population centres, and that will continue to be our strategy for the foreseeable future. It is also pleasing to know that the percentage composition each state represents within our investment accounts has also remained relatively consistent over the past 12 months. Now, for those of you who have been following our webinars over the last 12 months, you will know that we deliberately tilted our portfolios to residential loans through the COVID-19 period as an additional overlay of conservatism. That served its purpose very well, and we're certainly happy to see our commercial exposure start to rebuilding again. Note, however, that our portfolios are built from a bottom-up, asset-by-asset level. That means that portfolio holdings move very organically and will be some months before you would expect to see any substantial change in our portfolio holdings or trends. We're super comfortable about that approach too. We have had some questions around inner city apartment exposures. So you can see on screen that they're not a material exposure for our portfolios. We've never really been big in that space anyway. Now, moving on to more of a liquidity management. Moving to an overweight cash position was a very deliberate strategy when the potential impact of COVID-19 became clear. We still maintain elevated liquidity holdings, particularly within our shorter dated classic and 90-day accounts, and we are very comfortable there. We took an early view that we did not want to be rushed with the reinvestment process. This ensures a practical and pragmatic approach to reinvestment is maintained and allows us to continue to watch the macro and market and geopolitical developments closely to ensure we have plenty of tactical opportunity in our liquidity positioning. Noting the environment of elevated risk and uncertainty we operate within today, this prudence would appear imminently sensible. It is also worth noting that we remain one of the very few funds in the sector that has always met redemption requests in full at maturity, and we are entirely focused on retaining that track record across all of our offerings. If that means we sit overweight in cash at times of uncertainty, then we're happy to be holders of that position. Now, our portfolio managers have retained the discipline of reporting in the loan, our portfolios that are under pandemic-related hardship arrangements. You can see that each month in our snapshot and metrics report. For consistency and absolute transparency, and noting the potential of the impact due to the extended lockdowns in Sydney and Victoria, we will continue to include hardship as a discussion in these updates. In short, in 2020, hardships peaked and then receded swiftly, with no one sector or location overrepresented in our statistics, demonstrating strong borrower cohorts right across our loan book. As at the end of June 2021, across the entire fund portfolio of 9,783 loans, just 8 are in hardship. Just as pleasingly, the transition from hardship to arrears has also been ahead of expectations. Arrears levels have continued their declining trend and are now operating around long-term low levels across our book. The especially pleasing part of this is that new arrears are exceptionally low levels. That's a testament to the resilience of our borrower cohort, robust credit assessment practices, and also to the strength of the economic rebound post-hibernation. We anticipate no material change to these numbers, and to date, since the beginning of lockdown in Sydney and Melbourne in particular, we have not seen noticeable increase in either arrears or requested for hardship assistance. Of course, we will continue to report on borrower hardships as line item in our monthly portfolio snapshot and metrics, as just mentioned, and our mortgage help team will be working closely and sensitively with these borrowers who are impacted by current market circumstances, but are mindful of the objectives to protect investor capital. And the final point to bring to your attention is asset shortfalls. The table on the bottom of the screen shows asset impairments or shortfalls across the fund portfolios at well below long-term averages. That speaks to the quality of the book. While the 1-year numbers can move around a little bit, the 3-year numbers is a reflection of the quality of the asset to this book. To put this into context though, for the last 12 months, that represents only 1 cent for every $100 of loans in the 12-month term account resulted in an impairment loss within the investment account. This is truly remarkable indeed. Finally, the bottom line during the month of June portfolio continued to perform above benchmark. This again is a consistent outcome since our inception of our asset management operation. The consistency of performance can be shown in the graph on your screen, which shows the performance of $100,000 invested in October 2002 and compares it to a range of other asset classes. The dark blue line is cash, green is property securities, purple is bonds, red is global shares, grey is Australian shares, and light blue as our very own classic notice account. The thick orange line in the middle is the 12-month term account, which started in October 2002. The returns that it has delivered have been strong, even in absolute terms, across the 18 3/4 years or 225 months period in which it's been operating. Its performance is also incredibly consistent or low in volatility. It simply keeps on performing month in and month out and producing monthly income yields above market for our investors. That's important because it takes the question of having to correctly time the entrance or exit of your investment off the table. And timing can make a real difference to most asset classes. Additionally, it's worth noting that our classic 90-day, 12-month, and 4-year accounts continue their flawless track record. None of them have ever lost a cent of investor capital or missed a distribution. None of them have ever failed to pay an investor redemption at maturity. That's the performance profile we have designed over 7 decades for our investors. And of course, final reminder that we are looking to continue this stellar performance in our new 6-month notice account and our 2-year accounts. Now let's look at the property market. As we've touched on in a number of other recent webinars, the property market has seen a surge in results right across Australia. And it's a clear example of just how robust this asset class can be. Let's have a look. Most investors are aware of the increase and surge in residential house prices over the past 12 months. As a key component of individual wealth and a driver of our economy, residential property grew by 13.5% nationally over the last 12 months to 30th of June 2021. Indeed, house price growth has continued at near record pace. The only capital cities not to record double-digit growth were Perth, which recorded 9.8%, very close, and an annual growth rate, and Melbourne, which recorded 7.7% annual growth rate, both strong results in their own right, especially given the lockdowns that have occurred in Victoria throughout the past year. Sydney continues to be the location with the greatest growth over the past year, including around 2.6% of the June month alone. Time will tell, though, if these numbers continue once the current lockdown situation concludes in New South Wales, of course. Now, momentum remaining near record high, but population and medium-term headwinds, its residential property is not necessarily showing any signs of abating. Rolling 3-month results still show signs of very high levels of growth. Leading indicators such as clearance rates are still supportive of resilient market, while clearance levels still present across the cities are still high. While previous lockdowns had the effect of temporarily pausing market momentum, swiftly they returned, and the moment they ended, they did return to clearance rates pre-pandemic. As we have discussed in previous webinars, the true test will come as falling population growth numbers bite. To date, a swift fall in population growth is noted alongside moderation of dwelling completion. This twin dynamic moderates both demand and supply issues all at once. So in summary, market movements are not yet definitive in support of a cyclical softening in residential prices. It may just be that prices are simply moved from a really high rate of growth to a higher rate of growth in the coming period. But we will be watching the medium-term trends with expectations that growth rates will soften as lower population growth suppresses demand. The post-COVID-19 surge in house prices is not a phenomenon unique to Australia. Globally, the rest of the work from home, low interest rates, and rebounding economies have driven significant house price increases across most developed economies. While house prices are on the increase across Australian key cities, this is seemingly consistent message across the globe. Looking at the movement in Australian house prices versus other countries, though, shows that Australia's growth rates in a global context are actually quite modest. Thank you for your time. That's our portfolio summary and property update for the month ending June 2021. Now, for a look at the economy and review of our sector, I will hand over to Michael.
Thanks, Troy, and good morning all. Well, it's eminently clear to anyone in Australia right now, the coronavirus is not finished. The vaccine program is offering some hope, but there'll be false starts and periodic lockdowns very much remain our reality. Outside of Australia, key economies with strong vaccination numbers are reopening, and we're seeing the initial move towards restructuring to a new normal. Any new normal, of course, will certainly be against the backdrop of residual pandemic risk. Well, the title of this screen almost says it all. Against all of the uncertainty, our recovery from the hibernation in Australia has been quicker than almost any economist or commentator had expected, and it's been much more robust. Mid last year, it was commonplace to see projections of 12 to 15% unemployment and house prices down some 15 to 20%. Unemployment is now at 4.9%. And as we've just seen, there's been a surge in house prices both here in Australia and around the world. Of course, we can't ignore the fact that a large proportion of Australia is currently in lockdown. We're certainly not finished with the economic effects of the pandemic yet. It's noteworthy that the economic rebound continues with positive economic growth still forecast in the coming years from all key local analysts. So with that look at residential property prices and economists' views, let's now turn to our headwinds and tailwinds report. As mentioned, the rebound of Australia's economy after the initial impact of COVID-19 has been robust and swift, driven by a range of factors. Of course, risks persist, and we remain mindful of a range of factors which may impact the economy positively or negatively in the coming periods. A headwind that may cause some serious drag on the economy for some years is the impact of closed borders. It's forecast that by 2031, Australia may have more than 1 million fewer people than would have been the case. Population growth is a key driver of economic activity in any country, and strategically important with our demographics tilting towards an ever-aging population. In addition to potential impact on housing prices, the extent that these population forecasts prevail or are addressed could have long-lasting impacts on our economy and our standard of living. Immensely topical right now, the pace of Australia's vaccine rollout presents another key economic headwind. An unvaccinated population, well, it's prone to lockdowns under our existing strategy and restricts businesses from reopening or forward planning with any real confidence. The number of vaccines administered is growing, however, continues to fall short against the federal government's earlier objective of 20 million Australians vaccinated by the end of October this year. While noted as an economic headwind, there is a positive consequence of our slower vaccination rollout, which could be our ability to observe the health outcomes that highly vaccinated jurisdictions experience while they reopen their economies. Lessons from these locations, hopefully learned in the coming months, may be valuable to our own strategy and our own public health results. It's against the global context that Australia currently falls short. Other comparably wealthy nations with far larger populations have managed swift, efficient rollouts. These results are so important for consumer confidence, for business confidence, and of course, for forward planning of any kind. As we're experiencing presently, the go-to government response in lieu of a highly vaccinated population is rolling lockdowns. Indeed, every mainland Australian state has experienced some level of lockdown over the last 6 months. Whilst effective for ultimately quashing outbreaks, these lockdowns do have a distinct and immediate impact on economic activity. So we'll continue to watch closely the impact of the current lockdowns on economic activity. Another consistent economic headwind is the ongoing Australia-China trade tensions and their potential for impact on our economy. So far, overall impacts have been muted. As you can see on screen, with the surging demand for iron ore, our total exports to China are on a positive trajectory and are currently at all-time highs. While the macro trend might be positive, sector by sector, the impact of tariffs and bans has the real possibility of delivering targeted blows to our economy. To date, individual sectors impacted by tariffs or bans have seen disruption, but have largely managed to source alternate destinations with new trading partners. The challenge for our economy longer term is to manage this relationship with our key business partner and to better diversify our own export customer base. Moving now to economic tailwinds, which we anticipate to drive the performance of the economy in the period ahead, and starting with the macro commitment to expansionary policy settings. In 2020, we saw the success of fiscal policies such as JobKeeper and JobSeeker in maintaining employment and sustaining businesses. Together with monetary policy from the Reserve Bank, including maintaining low interest rates until at least 2024, we had a unified position of significant support. Importantly, this support has continued. State and federal governments have launched tailored, targeted mechanisms to support individuals and businesses. The Reserve Bank, it's reaffirmed its rate settings and provided clear guiding objectives. Even as recently as the July Reserve Bank minutes, the board confirmed its commitment to supportive monetary conditions. With the federal government and the state governments all in, and the Reserve Bank all in, this presents a real tailwind for the Australian economy. Australian households also at a macro level are at their strongest ever cumulative net wealth position. Investment in financial assets and rising property prices has seen wealth grow with only a minor impact during the COVID-19 period. Importantly, the underlying liabilities have been stable. This is genuine, unleveraged wealth creation that puts Australian households in great shape. A consequence of a locked-down economy, maintaining employment, but with restricted opportunity to spend, has been a spike in household savings ratios. This spike, which has begun to normalise, has Australian household balance sheets in great shape and provides a twofold benefit or tailwind to the economy. Firstly, high savings levels provide households with a cushion against future volatility, and that's hugely important as we navigate our way through this current period. Secondly, as savings rates normalise, this will ultimately manifest in a wave of consumption, further supporting growth in the economy. Unemployment numbers have been a standout data set of the last 12 months and have continued on that strong performance. Where multiple commentators, as I mentioned, had anticipated double-digit prints, unemployment peaked at just 7.4% before receding swiftly. It's now at the extraordinarily low rate of just 4.9%. An employed population, of course, has multiple benefits: consumption, confidence, and of course, for governments, each employed person represents a taxpayer contributing to national revenues. It's a testament also to the robustness of the entire economy that unemployment is also uniformly low throughout all states and territories. And you can see that on the right-hand side of screen. These low numbers represent people in work right across Australia, earning incomes and supporting all their local economies around the country. Tailwind 4 is our final tailwind. We look abroad to the economies of Australia's key international trading partners. The initial global rebound was, like in Australia, swift. Consider the chart on screen from Blackstone on the right-hand side, demonstrating the year-on-year change in GDP or gross domestic product across key economies and indeed the world. These were amazing turnarounds and has serious and powerful ramifications for us here in Australia. Each of our top 5 two-way trading partners are also rebounding strongly and also are set for positive growth into the years ahead. Also, this trend continues beyond our top 5 trading partners, well up to our top 10 and beyond. As trade is not one-sided, it's two-sided, a slew of rebounding economies trading with each other will be highly supportive of strong trade into the years ahead, and Australia is in a really powerful position as a result. So that was the headwinds and tailwinds report. We note prevailing headwinds of population growth, lockdowns, a slow vaccination rollout, and the ongoing Australia-China trade relationship. We also note key tailwinds, our combined fiscal and monetary responses, low unemployment, strong household balance sheets, and strong position of our key trading partners. Now, overall, we believe the net position, even noting the likelihood of volatility, is for continued economic resilience in the period ahead. And we now turn to the broader credit industry. The back half of 2020 saw strong RMBS issuances, which saw the year as a whole end as one of the stronger ones over the last decade or so. That in itself is incredible on the back of not just the pandemic, but the term funding facility and the surge in household deposits. And that resulted in our banks being incredibly well funded and actually having little need to go to debt markets. That trend continued in the first half of 2021, with similar volumes in the first 6 months of this year as to the first 9 months of last year. The comparatively strong Aussie outcome has assured continued demand for our paper, particularly those backed by Australian property, and so pricing for RMBS notes has dropped to record levels. The Structured Finance Support Fund, the SFSF, has served its purpose of maintaining market confidence admirably. Not only did it not need to deploy anything like the $15 billion that was set aside for it, its peak commitment of just $3.8 billion is receding as loans return to order or amortise. Likewise, the term funding facility served its purpose of providing certainty of funding for ADIs and at a time of low cost of funds. It was introduced at a time of skyrocketing costs of funding, so the TFF gave valuable assurance to a market during a period of heightened volatility. Let's conclude by way of a summary, as we always do, with a quick survey of our sector and any topical or emerging issues that we are monitoring. Having a look at corporate financials, our business is in excellent shape. We've maintained a strong balance sheet and liquidity position all throughout 2020 and 2021, and those serve as a buffer against adverse market events. The corporate balance sheet is in excellent shape and we're highly profitable. In fact, there was not a single month through the COVID-19 period in which we didn't grow as a business, notwithstanding all the market volatility. The business model, our business model, means that we are highly liquid and cash flow generative, and our capital position is strong and self-sustaining against the growth of the business. So we're really well positioned to continue to grow and develop the business in the months and years ahead. The official cash rate is at a record low of 10 basis points, as you're aware, and the Reserve Bank still maintains a commitment to this target of 10 basis points as their central scenario, that conditions won't be met to be supportive of a rise until 2024. Continuing from previous minutes, it has not specified a definition of full employment and considers the Australian economy, amazingly, well short of that goal. It's amazing when you consider our current position with unemployment at just 4.9%. In its July statement, the Reserve Bank confirmed that it will maintain rate settings until also we have inflation within the target range of 2 to 3%. Now, noting that inflation is currently rebounding, the scenario of 2024 sounds plausible, but is against secular downward pressures, including demographics and automation. And we'll watch with some interest the changing nature of the discussion around inflation. Arguably, inflation could be welcome as a mitigant to the increasing debt pile that around the world we are accumulating. So it's likely we'll see some real tolerance for inflation levels if and when they do materialise. Net effect of all of this, of course, interest rates will still be lower for longer. Given what's been happening with house prices, credit standards may well be a likely focus of the Council of Financial Regulators over the next 24 to 36 months. However, APRA data indicates that the banks have maintained vigilance here, and the Council of Financial Regulators has confirmed that. We note that investor credit growth remains subdued, and riskier lending types like high LVR loans, for example, are still at low levels. You'll expect to see lots of commentary on that issue if residential prices surge again post these existing set of lockdowns. Looking at the regulatory environment, there's two key pieces of legislation afoot to bring to your attention. The first is the federal government's proposal to replace responsible lending laws in the National Consumer Credit Protection Act with the APRA lending standards in APG 220. The other is the implementation of design and distribution, or DDO legislation, due to be implemented across the industry on the 5th of October 2021. And that will ensure that lending and investment products are suitable for their target markets. The former, lending standards, has continued to be delayed through the Senate, and there's no real clear picture as to when it might be considered. At the heart of the issue of credit regulation is how much emphasis should be put on responsible lending by the lender versus responsible borrowing by the borrower. The competitive dynamic, though, will ultimately be unchanged. The banks will compete ferociously for vanilla assets, and they'll do a good job in doing so. We'll continue to focus on our very distinctive space that supports the type of strong returns that we're seeking to generate for our investors. None of this means, and this point is really critical, none of this means that lending will be unregulated. The APRA standards outlined in APG 220 will continue to apply, as we've discussed, and there's a new overarching set of the design and distribution obligations, as I mentioned, that will require financial product issuers to ensure that their products are suitable for their target market. So lending is hard-baked in Australia as a highly regulated activity, and frankly, we don't mind that. It's appropriate that there be proper regulation around the financing of, well, the most significant and often the most costly purchase in most people's lives. That second piece of legislation, centering on design and distribution obligations, is due for formal implementation across the industry, as I mentioned, on the 5th of October. We're actively underway in preparing for the requirement. Collateral documents such as the TMDs, the target market determination documents, together with the underlying governance framework as well. So as we've already seen, the primary securitisation markets have been active, and that's continued into 2021. Record low pricing is making issuance very attractive, especially for those lenders with constrained funding models. We'll continue our practice of measured and programmatic issuance, consistent with our internal strategic and economic hurdles, and always with a focus on profitability, sound capital management, and diversification of funding sources. Net of all of this, the outlook is incredibly supportive and prospective, and we'll be very focused on continuing to deliver market-leading outcomes for our investors. So on that note, we'll now turn to questions, and I can see there's actually been quite a number of them, and also a few submitted in advance. So I'll take a moment now to go through a few. I'll group sort of them into themes, if you like. I'll start with one from Adam. Now, Adam's asked whether the new product offerings are guaranteed. Yes, of course. Now, the short answer to that, Adam, is that none of our products are guaranteed. While none of our portfolios, being the classic notice account, the 90-day notice account, the 12-month account, and the high yield 4-year account, have ever lost a cent of capital, we're not regulated by APRA. Our offerings are not guaranteed by the Australian government's deposit guarantee scheme. There's another question there from Sandra, who has asked about our view on inflation, which I think Troy covered off on, and I touched on slightly as well in the presentation as well, and whether inflation is likely to rise here in Australia. That's a very interesting question, and it's very topical with some prints out yesterday. We still may be some way off a significant inflation event, and I guess the concern with people asking about increasing inflation is that it's often followed by increasing interest rates. So as it relates to your investments with La Trobe, our portfolio accounts are all variable rates set and determined monthly. If we increase borrower interest rates, this ultimately increases and flows through into your return in your portfolio account. Therefore, you might say that our products are inflation responsive. We've got a couple of questions about the shopping list. One from Philip, and he's asked when we'll see a higher number of opportunities. Of course, our opportunities on the peer-to-peer shopping list. In short, Philip, the peer-to-peer offerings continue to be in incredible demand. We're seeing that each and every week. But also, we've been seeing increases on month-to-month loan originations from La Trobe Financial and settlements. So we do expect the shopping list to have increasing opportunities each week, and we're beginning to see that now and over the last month or so. There's a question from Steve. Yep, Steve, on the likely economic impact of the current lockdowns, and particularly, I guess, with New South Wales and Victoria, New South Wales in lockdown, Victoria just coming out of lockdown just now. It's a really good question, one we're watching closely. You saw earlier in the presentation, we had some stats around economic activity and how lockdowns have a sudden and material impact on economic activity. Last year, so if you think back to 2020, there was no real playbook for lockdowns. And as a result, the economy saw some huge volatility as each major area went into lockdown. This year, we're much better placed. Not that we're Pollyannas or forever optimistic, but we approach these current lockdowns with, as a nation, with low unemployment, with positive GDP, households with savings, as I mentioned earlier in the presentation, and that policy alignment between government and regulators. Of course, time will tell due to the, with the ultimate duration and severity of the lockdowns, particularly within New South Wales, but Australia as a whole, really well placed to meet these challenges with our economy intact, and well and truly intact, I should say. Question from Alexandria, and another couple along the same line regarding our new products and when they are available. Great question. The simple answer to the question is they're available right now. If you're an existing investor with us, you can invest straight away. So jump onto our La Trobe Direct app, or call our private wealth sales team if you've got any queries on 1-800-818-818, and they'll take you through all the ins and outs of that. To be respectful of time, I'm afraid I'll have to leave these questions there. I can see we've got some great questions left and across a whole range of different points of interest. Rest assured, we'll follow each and every one of you up directly to respond to your queries. And yeah, these people on screen, we'll do that. We'll do just that. Thank you for your attendance. And to those who ask questions that weren't addressed, one of the friendly staff members on screen now will get back to you shortly. Thank you once again for your attendance and your interest in our credit fund. It's our pleasure to be able to assist you with your investments. Thank you to Lillian, thank you to Troy, and thank you to our attendees. Thanks once again for joining us today and your continued interest in La Trobe Financial. If you'd like to discuss your investments with us or speak to us on any issue, please contact our investment team on 1-800-818-818. On behalf of all of us at La Trobe Financial, we wish you a great month and a great financial year ahead.